I want to start this video with a question that I think most people have never seriously asked themselves. And the reason they have never asked it is because the answer is uncomfortable. The question is this: if your bank decided tomorrow morning that you could only take out 5 cents of every dollar you tried to withdraw, would you even know it was happening before it was too late? Most people would say no, and most people would be right. Because here is what is actually happening right now in the American financial system, not in some theoretical future scenario, not in some worst-case projection from a doom and gloom blogger, but right now, this week, confirmed by regulatory filings, Bloomberg reporting, Reuters, the Financial Times, and CNBC, some of the largest and most recognizable financial institutions in the United States, have quietly told their investors that they cannot have their money back. Not all of it. Not yet. Maybe not for months. Maybe longer. Morgan Stanley told investors in its North Haven private income fund that it would return only 45.8% of what they asked to withdraw. Swiftwater, which manages $33 billion in private credit, capped withdrawals at 7%, even though investors requested 14%. Blue Owl Capital did something even more alarming. On February 19th of this year, it permanently closed redemptions on one of its funds, eliminating the quarterly withdrawal window entirely and telling investors they would receive only whatever distributions management decided to give them, whenever management decided to give them. And BlackRock, Blackstone, Morgan Stanley, Cliffwater, Blue Owl, Apollo, and HPS Investment, a subsidiary of BlackRock, have all in the first quarter of 2026 either capped, limited, gated, or permanently suspended investor withdrawals. Together, these institutions collectively received more than $10 billion in withdrawal requests in a single quarter and agreed to honor only about 70% of it. $3 billion in withdrawal requests from some of the most sophisticated institutional and retail investors in the world was simply told, you cannot have your money right now. And the reason that matters to you, even if you have never heard of any of these funds, and even if you do not have a single dollar invested in private credit, is because what is happening in these markets is the earliest, clearest, and most reliable leading indicator of what happens next across the entire financial system. And what happens next is something that every person in America with a bank account, a mortgage, a retirement account, or a job needs to understand before it arrives. Let me start with the basics, because I think the most important thing I can do in this video is make sure you fully understand what private credit actually is and why its problems flow directly into your life, because most financial media assumes you already know and then loses you in the details. Private credit is a $2 trillion market. Let me say that again because I want that number to land. $2 trillion. It is the shadow banking system. It is the part of the lending world that exists outside of traditional banks, outside of the regulatory frameworks that govern JP Morgan or Bank of America, outside of the FDIC insurance umbrella, and in many cases outside of the basic transparency requirements that force public companies to tell you what their assets are actually worth. Private credit funds are pools of money, often billions of dollars, that are gathered from wealthy individual investors, pension funds, endowments, and institutional managers, and then lent out to mid-sized companies that cannot get loans from traditional banks because they are considered too risky or too small or too complex. These loans typically carry higher interest rates than conventional bank loans, which is what attracted investors in the first place. In a world of near-zero interest rates that persisted for most of the decade after 2008, the promise of 8, 9, 10% annual returns from private credit funds felt like a gift. Money flooded in. Assets under management in retail accessible private credit funds ballooned from $34 billion at the end of 2021 to $222 billion by the end of last year. That is a 600% increase in 5 years. 600%. And the people who sold these products to investors marketed them using a term that I want you to burn into your memory, because understanding it is the key to understanding it is the key to understanding what is happening right now. They called them semi-liquid. Semi-liquid, not liquid. Not something you can take out whenever you need it like money in a checking account. Semi-liquid, which means you can request a withdrawal every quarter, subject to maximum limits that the fund manager can apply whenever they choose. The maximum limit, that gate, that is what is being applied right now. And the reason it is being applied is because investors are scared, and they are scared because the loans inside these funds are in trouble. And the loans are in trouble because the companies that borrowed the money are struggling to pay it back in an environment of persistently high interest rates and slowing economic growth. Here is the specific data that tells you exactly how bad it is getting inside these loan portfolios. Something called payment-in-kind loans, professionals shortened to PIK loans, jumped from 5% of the total private credit market in 2022 to 11% by 2025. A PIK loan is a structure where a company that cannot afford to pay its interest in cash is instead allowed to add the interest it owes onto the balance of the loan, essentially borrowing more money to pay what it already borrowed. On paper, the lender records it as income. In reality, no cash changed hands. The loan got bigger, the borrower got weaker, and the fund's reported performance looks fine right up until the moment it doesn't. The specific category called bad PIK, which is when a loan that was previously paying cash interest converts to deferred interest, jumped from 2% total private credit exposure in 2022 to 6.4% by late 2025. Morgan Stanley itself warned in the February 2026 report that approximately 50% of software sector loans inside these funds carry lower credit ratings, the kind that signal high default risk, and over 80% are issued by private sponsor-backed companies. Goldman Sachs analysts have predicted that the retail private credit sector could shed between $45 billion and $70 billion in assets over the next 2 years. And Mohamed El-Erian, former co-chief executive of PIMCO and one of the most respected macroeconomists in the world, has compared the current situation in private credit to the early stages of the 2008 financial crisis, when liquidity mismatches in structured credit products helped precipitate the broadest economic collapse in living memory. Now here is where I need you to pay very close attention, because this is the connection that most financial commentary misses entirely, and it is the connection that makes this story not about private credit funds, but about you and your bank and your money. U.S. banks have nearly $300 billion in direct exposure to private credit. Wells Fargo alone has $59.7 billion in loans to private credit funds, business development companies, and collateralized loan obligations. When private credit funds start limiting withdrawals, when the underlying loans inside those funds start going bad, when the PIK ratios keep climbing and the reported net A values start getting questioned, the pressure does not stay inside those funds. It travels outward. It hits the banks that lent to them. It hits the balance sheets of the major financial institutions that many of you have your money in right now. It hits them in a financial system that is already carrying $337 billion in unrealized losses on securities portfolios. As of the FDIC's Q3 2025 data, $337 billion in losses that exist on bank balance sheets right now, but are not officially recognized because the banks have not been forced to sell the securities yet. The same category of loss that killed Silicon Valley Bank. Let me tell you the Silicon Valley Bank story in a way that I think makes the current situation impossible to misunderstand. SVB did not fail because it was a reckless bank full of bad actors. It failed because it did something completely legal and extremely common. It took deposits that its customers had placed with it and invested a large portion of them in U.S. Treasury bonds, which are supposed to be the safest asset in the world. When the Federal Reserve raised interest rates aggressively in 2022, those Treasury bonds lost value. Not because SVB did anything wrong, just because that is how bonds work. When interest rates go up, the value of existing bonds goes down. SVB sat on those unrealized losses quietly because as long as it did not have to sell the bonds, the losses were not official. They were invisible. Then customers started needing their money back. And SVB had to sell bonds to raise cash to meet those withdrawals. And the moment it sold those bonds, it had to recognize the losses officially. And the moment it announced those losses, other customers panicked and rushed to withdraw their money too. $42 billion left the bank in less than 24 hours. An additional $100 billion was staged to leave the next morning. The bank had $209 billion in assets, and it failed in 48 hours because people wanted their money, and it could not give it to them fast enough. And that is exactly the dynamic that is now beginning to play out in the private credit market at a scale that is more than 10 times larger. The parallel I want you to understand is this. SVB's problem was that it had assets that looked fine on paper, but that could only be turned into cash at a loss. Private credit funds have the same problem right now. They have loans on their books that are being recorded at face value, but that in many cases are being paid back in more debt rather than in cash, and that in many other cases are not being paid back at all. The fund managers know this. The investors are starting to figure it out. And when investors figure it out, they do what investors always do. They ask for their money back, all at once, faster than any liquidity structure is designed to withstand. Cliffwater's $33 billion fund received withdrawal requests of 14% of its total assets in a single quarter, not from panicked retail investors. From sophisticated institutions that are supposed to hold these positions patiently. 14% in 1 quarter. If that rate of withdrawal continued for 4 quarters, 56% of the fund's assets would be gone. The fund's gates, capped at 7% per quarter, could not stop that if confidence broke. And when confidence in a fund breaks, when word gets out that you tried to take your money out and only got 45 cents on the dollar back like Morgan Stanley investors experienced, the next wave of withdrawal requests is always larger than the first. This is not speculation. This is the historical pattern of every liquidity crisis in financial history. It happened with the savings and loan crisis in the 1980s. It happened with long-term capital management in 1998. It happened with structured credit in 2008. It happened with SVB in 2023. And it is starting to happen now. Now let me add the layer that I think transforms this from a concerning private credit story into a potential systemic threat, because private credit did not build its $2 trillion empire in a vacuum. It built it by taking business away from traditional banks, which means those traditional banks are now deeply intertwined with the private credit ecosystem in ways that create exactly the kind of hidden interconnection that amplify crises. Those $300 billion that U.S. banks have lent to private credit funds means that if private credit funds start suffering real losses, those losses flow directly onto the balance sheets of the banks that lent to them. And those banks are already sitting on $337 billion in unrealized securities losses. And those banks are operating in an economy where the FDIC has 60 banks on its problem list, where commercial real estate loans, a $3 trillion market, are under severe stress as office vacancy rates remain near historic highs and refinancing at current interest rates is crushing property owners. And those banks are operating in a broader financial environment where the Moody's recession probability model sits at 49%, to 1 point away from the threshold it has never crossed without a recession following, and where the U.S. economy shed 92,000 jobs last month against an expectation of a 59,000 gain, and where GDP was revised down from 4% to 7%, and where oil is above $100 a barrel with the Iran war showing no clear resolution. Every single one of these pressures is real and measurable and documented, and they are all pointing in the same direction at the same time. Here is what I want you to understand about what it means when a financial institution limits withdrawals, because I think this is the most important psychological truth in all of finance, and the one to you that most people misunderstand until they personally experience it. When an institution limits withdrawals, it does two things simultaneously. First, it buys itself time to try to manage its way out of a liquidity problem. And second, it signals to every other participant in the system that there is a liquidity problem worth worrying about. The first effect is stabilizing. The second effect is destabilizing. And historically, the second effect almost always wins because information in modern financial markets travels faster than any institution can manage its way out of a crisis. When Morgan Stanley announced it was capping withdrawals at 5% of its North Haven fund, shares of Morgan Stanley fell 4% that same day. Blue Owl Capital shares are down 42% year to date. Blackstone shares are down 34%. Apollo Global Management securities are down about 31%. $100 billion in combined market value across these alternative asset management firms has been wiped out. Not because anyone has proven that these firms are insolvent, but because when withdrawals get limited, the market asks a question that is very hard to answer reassuringly. What do they know that we don't? Now I want to talk about something that almost nobody has explained clearly in this entire story, which is the specific mechanism by which a private credit stress event spreads to your regular bank account. Because I know that most people watching this do not have money in a Morgan Stanley private credit fund. They have money in a checking account. They have a mortgage. They have a 401k. And they are wondering why any of this matters to them. So let me be as direct as I possibly can. The way this spreads to your regular bank account follows a chain that goes like this. Private credit funds limit withdrawals because loan quality is deteriorating. Investors who cannot get money out of private credit funds need liquidity from somewhere else, so they start selling other assets. When institutional investors sell other assets at the same time, prices in public markets fall. Falling asset prices increase unrealized losses on bank balance sheets. Rising unrealized losses on bank balance sheets tighten the conditions under which banks will lend. When banks tighten lending standards, businesses cannot borrow to make payroll or invest in growth. When businesses cannot borrow easily, they cut costs, which means cutting jobs. When unemployment rises, consumers stop spending. When consumers stop spending, businesses see revenue fall. When revenue falls, the loans that private credit funds made to those businesses become even harder to repay. And we are back at the beginning of the loop, but at a lower point each time. This is what an economic doom loop looks like in its early stages. And the withdrawal limits at private credit funds are the earliest visible sign that the loop is beginning to spin. What do you actually do with all of this information? Because everything I have told you up to this point is about understanding the situation, and understanding alone does not protect your money or your family. So let me be concrete and specific. The single most important financial decision you can make right now is to understand the distinction between assets that are truly liquid and assets that are liquid only in normal conditions. Your money in a regular FDIC insured checking or savings account at a major bank is genuinely liquid up to the $250,000 insurance limit per deposit or per institution. That money is protected by law and by the full faith and credit of the United States government. Your money in a private credit fund, a non-traded REIT, a business development company, or any semi-liquid alternative investment vehicle is not liquid. It is subject to gates. It is subject to quarterly redemption caps. It is subject to exactly what Morgan Stanley and Cliffwater and Blue Owl investors are experiencing right now. Knowing which category your money is in before you need it is the difference between being a prepared investor and being a trapped one. The second thing is to understand what a gate on a private credit fund actually means for the timeline of getting your money. The base case scenario, according to financial analysts tracking the situation, is that gates remain in place for 12 to 18 months. In that base case scenario, the net asset value of these funds declines 10 to 20% as portfolio stress continues to build. Investors eventually get their money back, but at 80 to 90 cents on the dollar. In the pessimistic scenario, analysts give a 20% probability, gates remain for 3 to 5 years, significant defaults occur, and investors ultimately recover 50 to 70 cents on the dollar. If you have money in any of these vehicles right now, that probability distribution is your reality, not the prospectus return of 9% per year. The real question of how much and when you get your money back in a stress environment is your reality. And the time to understand that reality is before it becomes personal. The third thing is to watch one specific number in the coming weeks because it is the single most important signal of whether what I have described today remains contained within the private credit market or begins to spread to the broader banking system. That number is the high-yield credit spread, the gap between the interest rate that safe U.S. Treasury bonds pay and the interest rate that risky corporate bonds pay. Right now, those spreads are widening. Check high-yield credit spreads have already jumped to 556 basis points, the widest level since October 2023. Broader high-yield spreads are at 361 basis points, the highest since November of last year. If those spreads continue to widen, it means the private credit stress is beginning to transmit into the broader corporate credit market. And if that happens, everything I described in the doom loop above begins to accelerate. Watch the credit spreads. They are telling you something the stock market headlines are not. 4 things to make sure you understand the FDIC insurance limits on your deposits, because in a world where 60 banks are on the FDIC problem list and where $337 billion in unrealized losses sit on bank balance sheets, the distinction between insured and uninsured deposits is not theoretical. Silicon Valley Bank had 89% of its deposits above the $250,000 FDIC limit. When it failed, those uninsured depositors were in genuine danger of losing their money for 2 days before regulators stepped in and guaranteed everything through exceptional emergency powers. Exceptional intervention is not guaranteed every time. The FDIC used special systemic risk exception powers to protect SVB depositors precisely because of the contagion risk. In a situation where multiple banks face stress simultaneously, those exceptional powers may be slower to apply or more politically contested. $250,000 per depositor per institution. If you have more than that at any single institution, spread it now. Before you need to, the 5th thing, and this is the one that I know sounds counterintuitive, is to understand the opportunity that is embedded in what I have just described. Because every financial crisis in modern history has created asymmetric opportunities for people who were prepared, who had liquidity, who were not forced sellers, and who had a framework for understanding what was happening while others were reacting emotionally. The 2008 crisis created generational wealth for people who had cash in March 2009 and bought quality assets at prices that will never be seen again. 2020 COVID crash created the same opportunity for the same kind of prepared investor. If what I have described today escalates, and there is genuine risk that it will, the assets that fall the hardest will be the ones that are most liquid, most publicly traded, most easily sold by people who need cash quickly. Those assets eventually recover. They always do. And the people who have the financial resilience to hold through the decline and the liquidity to buy during it are the ones who emerge from the other side in a fundamental stronger position than they entered. Preparation is not pessimism. It is not predicting doom. It is simply acknowledging what the data is saying and making rational decisions that account for a wider range of outcomes than the optimistic base case. The data right now is saying that Morgan Stanley returned less than half of what investors asked to withdraw. Cliffwater capped redemptions at 7% when investors wanted 14%. Blue Owl permanently closed withdrawals on a fund holding retail investor money. $10 billion in withdrawal requests in a single quarter were not fully honored by the largest private credit managers in the world. $265 billion in market capitalization has been wiped out from alternative asset management firms since September. $337 billion in unrealized bank losses sit quietly on balance sheets. That 60 banks are on the FDIC problem list. The Moody's recession model is at 49%. That credit spreads are at their widest in years. The first U.S. bank of 2026 already failed in January. And that all of these signals are converging at a moment when oil is above $100 a barrel. Inflation is reaccelerating. The Federal Reserve is paralyzed between 2 bad choices. And the world's central banks have just confirmed that for the first time in 30 years, they trust gold more than American debt. I'm not telling you the system is about to collapse. I'm telling you that the system is under stress that is measurable, documented, and historically significant. And I'm telling you that the people who are already preparing for that stress to intensify are the same kind of people who prepared in 2007 and came out of 2009 in the strongest financial position of their lives. Be that person. Understand your liquidity. Understand your insurance limits. Understand what semi-liquid actually means when you need the money. Watch the credit spreads. And pay attention to what is happening right now, this week, in the private credit market, because it is the earliest and clearest signal of what the rest of the financial system may be about to experience. It is starting, not with a crash, not with a panic headline, not with a bank run that shows up on the evening news. It is starting quietly in regulatory filings, investor letters, and the gap between what people asked to withdraw and what they were allowed to take. It is starting exactly the way every financial crisis in history has started. Slowly, and then suddenly. And the people watching this video right now are being given the chance to be on the right side of that transition. Do not waste it. If this video helped you understand something important that you are not hearing anywhere else, please subscribe and hit the notification bell, because this story is moving fast, and I'll be tracking every major development in real time. Share this with someone who has money in the market or a savings account or a retirement fund, because they need to understand what is happening right now. And leave a comment below telling me what you found most surprising, because I read every single comment, and your questions shape what I cover next. The withdrawal limits are here. The question now is what you do before the next round gets even smaller.